Why your credit score impacts your interest payments so much. When lenders evaluate whether to lend you money, they assess your credit risk. Your credit score tells them how likely you are to repay the loan on time. A high score means lower risk, and therefore better loan terms and lower interest rates. Conversely, a lower score signals higher risk, leading lenders to charge you more interest or deny you credit altogether. To illustrate the impact, imagine taking out a 30-year mortgage for $300,000. With an excellent credit score, say 760 or above, you might secure an interest rate around 5%, which totals roughly $279,000 in interest paid over the life of the loan. But with a score below 630, your rate might jump to 7.5%, costing you over $455,000 in interest. That's nearly $176,000 more paid simply because of your credit score. Even for smaller loans, like auto or personal loans, or for credit cards, the difference in interest rates due to your credit score can add up to thousands over time. So it's clear that improving your credit score is more than just a vanity project. It's a smart money move. Hack 1. Keep your credit utilization ratio low. Your credit utilization ratio, which is the percentage of your available credit you're currently using, makes up about 30% of your credit score. Experts recommend keeping this ratio below 30%, but if you want to boost your score, aim for under 10%. For example, if your total credit limit across all cards is $10,000, try to keep your balances below $1,000. The lower your utilization, the more lenders see you as responsible and less risky. Act 2. Always pay more than the minimum payment. Paying just the minimum on your credit card bills not only extends your debt, but also keeps your utilization ratio high, hurting your score. Whenever possible, pay off the full balance. This practice shows lenders you can manage credit responsibly and keeps your credit utilization low. If paying the full balance is impossible, paying more than the minimum helps reduce your debt faster and improves your score over time. Hack 3. Request a credit limit increase. If you have a good payment history, asking your credit card issuer for a credit limit increase can improve your credit utilization without changing your spending habits. For example, if you owe $1,000 on a card with a $3,000 limit, 33% utilization, and your limit increases to $6,000, your utilization drops to 16%, which positively impacts your score. Be cautious though, don't use the increased credit line to rack up more debt. The goal is to improve your ratio, not your debt load. Hack 4. Become an authorized user on someone else's account. If you're struggling to build or improve your credit, becoming an authorized user on a trusted friend or family member's credit card can boost your score quickly. Their good payment history and low credit utilization will reflect on your credit report. Make sure the primary cardholder is responsible, as any negative behavior on their part will also affect your score. Hack 5. Automate your payments to avoid late fees and missed payments. Payment history accounts for 35% of your credit score, making it the single biggest factor. Even a single late payment can cause a significant score drop. The easiest way to prevent late payments is to automate your bills. Set up automatic payments for at least the minimum amount to avoid missed payments. You can also schedule payment reminders to maintain control over your finances without risking penalties. Hack 6. Regularly check your credit reports and dispute errors. Mistakes on your credit report can unfairly lower your score. Roughly 20% of credit reports contain errors that could affect your creditworthiness. These might include incorrect late payments, accounts that aren't yours, or outdated information. Obtain free credit reports from the 3 major bureaus, Equifax, Experian, and TransUnion, at least once a year through annualcreditreport.com. If you spot errors, dispute them immediately. Removing inaccurate negative information can provide an instant score boost. Hack 7. Use credit boost tools. New tools like Experian Boost allow you to add positive utility, phone, and rent payments to your credit history, which weren't traditionally counted in your score. For those with thin credit files or limited credit history, these alternative payments can help build your score faster. if you regularly pay rent, utilities, or phone bills on time, linking these accounts to your credit report can give you a leg up. Hack 8. Keep older credit accounts open. The length of your credit history accounts for 15% of your score. Closing old accounts reduces your average account age and can lower your score. Keep your oldest cards open, even if you don't use them frequently. If the card has an annual fee, consider calling to request a no-fee alternative, or simply use the card once every few months and pay it off immediately. Hack 9. Diversify your credit mix. Having different types of credit, like credit cards, installment loans, car, student loans, and mortgages, can positively influence your credit score by demonstrating you can handle various credit responsibilities. You don't need to open new accounts unnecessarily, but maintaining a healthy mix can help if you're planning for major financing. Hack 10. Time your credit applications wisely. Each credit inquiry can temporarily lower your score by about 5 points. Applying for multiple credit products in a short span can raise red flags for lenders. If you're rate shopping for a mortgage, auto loan, or a student loan, do all your applications within a 14 to 45-day window. Most credit scoring models count multiple inquiries within this time frame as a single inquiry, minimizing the impact on your score. Hack 11. Consider secured credit cards to build or rebuild credit. If you have a low credit score or no credit history, secured credit cards are a useful tool. You deposit money up front as collateral, which becomes your credit limit. Responsible use and on-time payments help build your credit profile and eventually qualify you for unsecured cards. Many secured cardholders see their scores rise within months of consistent, responsible use. Putting it all together, how these hacks save you thousands. Improving your credit score can lead to drastically lower interest rates across all types of borrowing. Here's a rough breakdown of potential savings. Mortgage loans. Saving just 0.5% on a $300,000 mortgage can cut your interest by $12,000 or more over 30 years. Improving your score even more can save tens of thousands. Car loans. Better credit can reduce your interest rate by a few percentage points, saving you $2,000, $5,000. Credit cards. Lower APRs and better terms can save you thousands in interest payments and fees. Personal loans and other credit. Even small improvements can save you hundreds or thousands. These savings add up quickly, proving that investing time and effort into your credit health is well worth it. Final thoughts. Your credit score is a crucial factor in your financial success, affecting everything from loan approvals to interest rates. While it can feel complicated, improving your credit is largely about consistency, responsibility, and smart strategies. By using these credit score hacks, keeping utilization low, paying on time, disputing errors, and strategically managing your accounts, you're not just improving a number, you're unlocking huge potential savings in interest that can add up to $20,000 or more over time. Start implementing these tips today and watch your financial opportunities and your peace of mind grow. Let me know in the comments section below. What do you think of our video? If you enjoyed this video, make sure to hit that like button. Also, subscribe to our channel before you go. Thank you for watching.